Farmers across Wisconsin are no strangers to navigating uncertainty, from changing weather to fluctuating markets. But what does this mean for their financial future? I'm Charity Seebecker for the Midwest Farm Report, and I checked in with Jeff Wilke, the chair of the Ag Bankers section of the Wisconsin Bankers Association, to get an inside look at how the lending landscape is shifting in his neck of the woods in northeast Wisconsin. He touches on what that means for farmers as they plan their next move.
I'm in northeast Wisconsin, which is predominantly dairy, and I would say cautiously optimistic, certainly with the recent tariff situation that put the mood at a little more negative, but most of the exports that we do on the dairy side go to Canada and Mexico, which, there's been some negotiation there. So I think cautiously optimistic is a good way to put it. Interest rates are, of course, higher than what they were 2 years ago, so there's that impact. But we have seen some expansion with the dairies. The cheese plants seem to be opening up a little bit with wanting to take more milk, so there's some opportunity there. And then inflation, of course, expenses are still higher than what they were before the pandemic and that, so that also adds to the mix. But farmers are resilient. They find ways to become more efficient, and if it makes sense, even if it is going to cost a little more money to do so in the long run, they feel that they still want to make those investments.
You mentioned some of the trends that you're seeing already, but are you seeing other ones when it comes to maybe like more consolidation or even equipment upgrades or transitions in farm ownership right now that stand out in your area?
Yeah, certainly consolidation. The big guys are getting bigger, and the smaller guys are kind of getting out. There's exceptions. I work with smaller farms, bigger farms, the whole spectrum, and it really comes down to management. Yeah, there's some advantages with economy of scale with the bigger operations, but still at the end of the day, it's the management. It's the financial structure. If they don't have a lot of debt, certainly that helps to alleviate the debt service and help the cash flow. But we have seen more, with the farm transition plans and that. It seems like the farmers are becoming more and more sophisticated with that and the tax advantages and that. So I think we're involved more with those situations too, and figuring how to structure a buyout, between one generation to the next.
Are banks taking a more cautious approach then to lending, or are they still actively supporting growth in the ag sector with kind of all of the things that are going on? How is that relationship continuing?
Yeah, certainly on the dairy side, I think if it's a deal that makes sense, the cash flow is there, yeah, we're all on board. There is more of a challenge on the crop side. Grain prices have been low, and they continue to project to be low, especially with the export market and the impact of tariffs. So I think we're looking at that sector a little more conservatively because of the risks there related to price and opportunities for exports. But on the dairy side, we are definitely open for business.
Are you seeing more farms struggle to manage their debt then with the increase of interest rates like you mentioned, or are they finding decent ways to adapt? What are you seeing in your area?
Certainly, they were fortunate. Many of them locked in rates when they were lower, and they're still kind of riding that low rate environment on some of their longer term debt. On the operating side, they've had a look at, increased interest expense, for lines of credit and that. Many of them are realizing or hoping that, the trend is that rates will go down a little. We'll see on that front, whether inflation or the tariffs, all of that mix could create either inflation, which would require rates to stay where they're at or go up a little, or it might create a recessionary period where rates would then have to shift down.
And what are some of the steps that you as ag bankers are taking to help your clients manage those higher costs and keep their operations financially stable and kind of balance and have a good step forward now?
Yeah, I think it all comes down to good financials, understanding, the impact of taking on more debt. If it makes sense to improve the operation or to make it more efficient or save cost in the long run, we want to have those conversations. We also are pushing for projections so that the farmers realize that, hey, this is kind of the outlook. Let's put something together that at least you can budget, and then based on that determine whether or not it's something that makes financial sense.
And with the input costs rising, market uncertainty, all these things that are happening, what are some of the most common questions or concerns that you're getting from your farm customers? What are they coming to you with?
Yeah, I think certainly they're concerned about what could happen politically in the tariff situation. There's certainly some stress there out of their control. So I think we have conversations on what they can control and really look at their financial situation, kind of go down their income statement, look at the income sources, maybe try to market some of their products so that they've locked in some prices on the revenue side, and then on the expense side, look at each expense item and really figure out what impact it's going to have going forward, and try to look for ways to cut those costs, but at the same time, with the cut in the costs, not impacting the quality of the product that they're producing.
That's Jeff Wilke, chair of the Ag Bankers Section Board, along with us. Whether it's navigating interest rates, expanding operations, or passing the farm to the next generation, farmers and ag lenders alike are keeping a close eye on what's next. For the Midwest Farm Report, I'm Charity Seebecker.